You've probably felt it, that tightening in your budget, maybe some unease about the future of your finances. Today, we're doing a deep dive into what's truly impacting your wallet in, well, these challenging times. Our mission is to unpack the current economic landscape. We're drawing insights from a conversation with a seasoned personal finance expert and Washington Post columnist. We'll explore how recent policy decisions are hitting individuals and families, but more importantly, we want to equip you with strategies to navigate these shifts successfully. So let's start by looking at some broad national financial policies. What are our sources telling us about the direction things are headed?
Okay, well, we're seeing widespread impacts starting pretty immediately with tariffs.
Tariffs, right.
Yeah, and while they're sometimes framed as, beneficial for domestic industries, these tariffs, particularly on things like autos and steel, they directly increase costs for everyday goods you buy.
So it's not just a small thing.
No, not at all. This isn't just a slight bump. It actually impacts your ability to save for significant life goals. Think a child's college fund or your retirement.
Because things just cost more.
Exactly. Cars, clothes, even washing machines, they can cost more. The key insight here isn't just that things cost more, but these sort of hidden taxes, they can disproportionately burden households already stretched thin. It forces immediate, sometimes difficult reevaluations of those long-term financial goals.
That's a clear picture of how tariffs hit our daily spending.
Okay.
But as we look at the broader landscape, what about the foundational support systems, our social safety nets? How are they being reshaped by these policy decisions?
Right. So what's crucial to understand next is the significant changes to our country's social safety nets. Take healthcare, for instance. We're seeing cuts and new obstacles being put in place for accessing programs like Medicaid and the Affordable Care Act, Obamacare.
Like what?
Well, things like increased forms, maybe having to re-register more often, or even, lost paperwork. Critics argue these aren't just bureaucratic hurdles, they create real barriers to access. And that could potentially lead to fewer people participating in these programs. Imagine families already navigating complex health challenges. This can be immense.
Yeah, that sounds incredibly stressful.
It really is. I've experienced this personally with my son who has autism. Navigating those constant reapplications for vital programs, it can be an incredibly draining challenge. And these changes also shift a greater financial load for healthcare onto the states.
So it's not just individuals feeling it.
No. And beyond healthcare, we're seeing similar pressures on food assistance, cuts to SNP, the Supplemental Nutrition Assistance Program.
Food stamps.
Right, food stamps. It means more hurdles for people just trying to put basic food on their tables.
Right.
And housing is another critical area. The Department of Housing and Urban Development, HUD, has seen significant funding reductions.
How significant?
We're talking a 44% cut overall. And HUD's role is crucial. It protects consumers from scams. It helps with Section 8 housing, that's the federal program for rental assistance for low-income families, and it ensures fair lending practices for mortgages.
So really important consumer protections.
Absolutely. When an agency like HUD faces such substantial reductions, it can leave more people vulnerable, to being taken advantage of in one of their biggest financial commitments, buying a home.
That really underscores how these policy shifts ripple into the daily lives of families. Okay, now moving from these broader economic shifts, let's zero in on something huge. Student loan debt, a financial burden carried by millions. What's the current situation and what major changes are on the horizon there?
Yeah, student loans. The U.S. is grappling with over $1 trillion in student loan debt. It affects undergraduates, graduates, even parents. And yes, major changes are indeed coming next year.
Okay, like what?
For payment plans, those income-driven repayment options.
Right, the ones that adjust based on your income.
Exactly. Those are designed to make monthly payments more affordable. Well, they're being scaled back from multiple choices down to just one income-driven plan and one standard plan.
And that
means higher monthly payments for many people. Also, a critical safety net is being removed. The ability to defer loans and stop interest accrual when you lose your job, that's going away.
Wow, that's a big change, losing that buffer.
It is. And this is another big one. New borrowing limits. There's this prevailing belief, you hear it a lot, that people have been borrowing way too much for college. So Parent Plus loans, which previously allowed parents to borrow, frankly, amazing amounts.
Yeah, almost unlimited, practically.
Pretty much. Well, they're now capped, $20,000 per year and $65,000 total.
Okay, so that's a hard stop.
It is, and it forces families to make different decisions, often difficult decisions about higher education, like maybe choosing an in-state school instead of that dream out-of-state one. My own family, we sent 3 kids through college with no debt because we had strict limits on what we'd pay. My oldest, she really wanted to go out of state, but when we looked at the numbers saving scholarship money, it just didn't add up. So she went to our state university instead. She was disappointed at first, sure, but it worked out.
That personal story is incredibly powerful. It really illustrates the kind of choices families face. So we zoom out. What's the broader implication of these changes for families navigating higher education? It sounds like a forced reckoning with how we approach college financing.
Absolutely. A forced reckoning is a good way to put it. In our financial organization, a large percentage of participants, many in their 50s and 60s, carry significant student loan debt.
Not just a little bit.
No, not just $10,000. We're talking up to $200,000. And these aren't all doctors or lawyers. For graduate loans, there are also new caps. $20,500 per year and $100,000 total. And I've seen instances, really, where people almost took on, say, $100,000 in grad school debt only because the school advised them they needed the degree for a certain career path. One person, after we challenged them on it, actually quit the program. And guess what? They got their desired federal job a year and a half later without the degree.
Wow. So sometimes the degree isn't actually necessary.
Exactly. It proves that some degrees, frankly, are simply not necessary for career advancement. You need to question that. And limits on law and medical school debt, these raise particular concerns for minority students who often start with fewer financial resources.
How so?
Well, it might force decisions like living at home during school, definitely choosing in-state schools, or maybe moving back home right after graduation just to save money. These limits might also push people, and this is worrying, into the private loan market.
Which is generally more expensive, right?
Much more expensive, and it offers fewer consumer protections than federal loans. It's a potential trap.
So what are the alternatives then, besides just taking on less debt?
Well, consider community colleges for the first 2 years. Seriously. You can save a fraction of the cost, transfer credits later, and still get a quality education. My own son got an accounting certificate from our local community college, saved a ton of money compared to a university. The goal really has to be avoiding decades of debt just for college.
Right. Being more strategic, maybe less traditional in how we approach higher education planning. Okay, so beyond personal debt, there's another major area of impact our sources highlight: widespread job losses, particularly in the federal sector. Could you elaborate on what we're seeing there?
Yes, what's equally concerning, frankly, is the impact of these widespread job losses. We're seeing hundreds of thousands of federal workers impacted, particularly in areas like the DMV, DC, Maryland, Virginia.
And there's often a narrative about federal workers, isn't there?
There is. The narrative often suggests these workers are, lazy or inefficient, but data, for instance, from the Washington Post, actually proves they often work harder and longer hours than many in the private sector. And these job losses, they don't just decimate individual livelihoods.
It ripples outward.
Exactly. It ripples through entire communities. Think of all the businesses that support the federal government and federal contractors. They get hit too.
And is there a demographic aspect to this?
There is, and it's important to recognize. Federal jobs historically represented a significant pathway to middle income status for many minority families. The scale and the targeting of these cuts, particularly in cities with large minority populations, have led to criticism. Critics argue they disproportionately affect certain demographic groups and undermine those traditional pathways to the middle class.
Can you give some examples? Specific agency impacts.
Sure. The Consumer Financial Protection Bureau, the CFPB.
Created after the housing crisis.
That's the one. Created to protect consumers. Its funding has been slashed by 50%. Critics argue this reduction in oversight primarily benefits big business, not you, the consumer. The Education Department, 1,400 employees cut. These are the people who help students manage their loans.
Right when loan changes are happening.
Precisely. The Department of Defense, over 60,000 people impacted. Essential for our protection. And the Veterans Administration, the VA. This one is shocking. 83,000 employees laid off.
83,000, that's staggering.
It's been called criminal by some. The VA was already overwhelmed trying to serve veterans who put their lives on the line. These cuts severely impact those who served our nation, many of whom came from lower-income backgrounds or are people of color.
Those numbers are indeed stark, especially the VA cuts. From a policy standpoint, is there any argument given for why these specific cuts were deemed necessary, even with such a severe known impact?
Well, the arguments you typically hear for such cuts revolve around reducing overall government spending, finding efficiencies, streamlining operations, that kind of thing.
The standard justifications.
Right. But the practical impact on service delivery and on individual lives, as we're discussing, is just profound. These extensive job losses impact families significantly. It leads to strife, forced relocations, economic damage to local economies. And this is precisely why personal financial preparedness is, well, it's no longer just good advice, it's really a necessity.
So bringing it back to the listener, what does this all mean for you? How do we prepare? How do we adapt in the face of these significant shifts?
Yeah, the answer really lies in doubling down on those personal finance fundamentals. We're providing something, a Hope Resources Guide, we call it, Helping Our People Endure. This lists places for employment help, support services, housing assistance, food resources, all in one place.
That sounds incredibly helpful.
And please, I have to say this, there is no shame in asking for help if you've lost your job or are struggling, none. Pride can be a real barrier, but these benefits, these resources, they are there for you. Also, our organization offers free year-long financial classes via Zoom. We pair you with accountability partners.
What do you teach in those?
We teach you how to budget, how to save, how to get out of debt, the basics, but with support.
Yeah.
And look, if you're currently employed, now is the time to be incredibly tight with your money. Save aggressively, build that buffer.
That emergency fund.
Exactly. Think of it like the Joseph principle from the Bible story. If you save during times of plenty, you'll have enough when times get lean. And not just for yourself, but maybe to help others in your family, your community, your church, or community group.
That idea of saving a gap, not spending every single dollar that comes in, is so crucial for individuals, just like it is for organizations. Aiming for maybe 3 to 6 months of living expenses in savings, in reserve. Now, we've received some excellent questions from listeners based on these topics. Let's try and tackle some specific ones. First up, could you clarify the difference between Medicare and Medicaid? People often mix those up.
Yes, happy to. It's a common confusion. Medicaid is health insurance primarily for low-income individuals and families, people with very few resources. Eligibility varies by state. Medicare, on the other hand, is the federal health insurance program mainly for seniors, people 65 and older, and also for some younger people with disabilities. It's linked to Social Security.
Okay, that's clear. Now, related to that, if you're 65 but still working and have health insurance through your job, should you take full Medicare? Or only what's required for Social Security?
Good question. If you're 65, still working, and covered by a decent employer-provided health plan, you often can stay on it. You don't necessarily have to switch fully to Medicare right away. However, and this is important, if you don't have coverage through work, or if your work coverage isn't considered adequate, and you wait to sign up for certain parts of Medicare after you turn 65, you could face lifetime penalties, late enrollment penalties.
So there are potential downsides to waiting.
Yes. You can also choose to enroll in Medicare, and then your employer plan might become secondary coverage. It's really important to consider your specific options carefully as you approach 65. Weigh your current coverage against Medicare benefits, costs, and those potential penalties.
Makes sense. Okay, let's switch back to loans. Parent Plus loan repayment. What's changing there specifically, and what are the implications for families who have those loans?
Right. As we mentioned, the income-driven repayment options are being consolidated. This will likely lead to higher monthly payments for many Parent Plus borrowers compared to some previous options. The Biden administration's Save-E plan, which offered significant payment reductions for many by linking payments to a smaller portion of discretionary income, well, that specific plan is likely going away or being significantly altered.
So less generous repayment terms overall.
Likely, yes. And remember those new borrowing caps we talked about, $20,000 per year, $65,000 total for new Parent Plus loans. While parents were previously able to borrow, as I said, amazing amounts, these new limits force more realistic college choices up front. And it really underscores the need for parents to prioritize saving for their children's education early, maybe over, say, buying a new car or other things that lose value.
A necessary shift in priorities, perhaps. Okay, next question. Many listeners are asking about buying a home. Given current interest rates and market conditions, would you recommend moving forward now? What steps would you suggest?
This is always a big one. My advice is don't let interest rates be the sole dictator of your decision.
So it's not just about the rate.
No. The right time to buy is when you are personally ready and financially prepared. I strongly recommend consulting a HUD-approved housing counseling agency. They can help you figure out if you can truly afford the mortgage, the taxes, the insurance, the upkeep, while still saving for other important goals.
Getting that independent advice.
Yes. A general rule of thumb we use: try not to spend more than about 1/3 of your take-home pay, your net income, on total housing costs. And please remember, renting is not a failure. You can absolutely build wealth as a renter too. Don't feel pressured into buying before you're ready.
That's a great point. And related to housing, what about shared or multi-generational housing? Is that becoming more necessary or accepted?
Absolutely. It's okay and often really beneficial to have shared or multi-generational housing arrangements. Our own home and many homes in our community group have welcomed family members or friends during times of financial difficulty. This practice is very common in many cultures around the world, and it provides critical support during economic downturns. It helps families survive, save money, and support each other. It's a strength.
Good perspective. Okay, question about debt legacy. What happens to federal student loan debt if a parent who took out a Parent Plus loan passes away? Is the child responsible for paying it back?
No, this is important. A child is not responsible for repaying a parent's federal student loan debt if the parent passes away. Federal Parent Plus loans are discharged upon the death of the parent borrower.
That must be a relief to many.
It is. And it's also a good reminder to be very cautious about co-signing loans in general, especially private loans, because co-signers are usually responsible if the primary borrower can't pay or passes away.
Right, co-signing carries real risk. Okay, scholarships. Are there resources for full-ride scholarships specifically for mature learners, people going back to school later? And generally, how common are these full rides people dream about?
Full-ride scholarships do exist, but let's be realistic. They are awarded to a very, very small percentage of students, whether they're fresh out of high school or mature learners.
So they're rare.
Extremely rare. Don't exhaust yourselves or your kids chasing athletic scholarships hoping for a full ride, or running kids ragged with activities solely for that purpose. It's usually not the most effective strategy. Focus instead on consistent saving, exploring affordable in-state options, community colleges like we discussed. And it's worth noting, again, a significant chunk, sometimes half, of student loan debt is often taken out just for campus housing.
Which is basically rent.
Exactly. It's essentially borrowing money, often at interest, to pay rent. You wouldn't typically borrow from a bank each month to pay your apartment rent, so try to avoid doing it for college housing if you can't afford it out of pocket or through work.
Good point. What about Public Service Loan Forgiveness, PSLF? Has that program survived recent changes? Are there any updates?
Yes, the PSLF program has survived, which is good news for many working in government or qualifying nonprofits. There is, however, ongoing discussion about its future and potentially tightening the definitions of qualifying employment. Some nonprofits that currently qualify might not in the future, but that's still under debate. For now, though, it remains a viable pathway for loan forgiveness for those meeting the specific requirements 10 years of payments while working in a qualifying job.
Okay, good to know it's still there, at least for now. Last question. This one's about retirement timing. For those turning 65, if you're in great health and maybe have a good pension, should you start receiving Social Security right away? Or does waiting actually increase your benefit?
The Social Security timing question. Yes, absolutely. Waiting can significantly increase your monthly benefit. For every year that you delay collecting Social Security past your full retirement age.
Which varies, right, depending on your birth year.
Correct. For many people listening now, it's likely 67. But for every year you wait between your full retirement age and age 70, your monthly benefit increases by about 8%.
8% per year. That's substantial.
It is. It's essentially a guaranteed return, often much better than you can safely get in the stock market over that short period. So, if you're healthy, have other income sources like a pension or savings, and expect to live a reasonably long life, maybe look at your family's longevity. Delaying Social Security until age 70 can provide a much larger inflation-adjusted income stream for the rest of your life. It's a very personal decision, though.
Wow, okay. We've covered a lot of ground in this deep dive, really uncovering the intricate ways current policies are impacting personal finances, from tariffs to job losses to student debt.
Yeah, we have. And remember, our goal here isn't to scare you, it's really to empower you. We can't always rely solely on external systems, on the government. That's becoming clearer. That means we must take command over our own finances, manage the resources we have, whether they feel like a lot or a little, and be ready to help each other.
That community aspect again.
Yes. When you save, when you manage your money well, you create abundance, not just for yourself, but potentially to support your family, your community, your church, or local groups. You build resilience.
That leads to a really powerful thought, doesn't it? In an era where some essential programs seem to be scaling back, the strength of our personal finances and just our willingness to support one another, that becomes more critical than ever.
Couldn't agree more.
So for more practical guidance, and if you want to join a supportive community focused on these things, check out Prosperity Partners. They meet the third Saturday of every month via Zoom. You can find the registration details and that Hope Resources guide we mentioned on the FPCG website. And this isn't about just, getting more stuff. It's about building genuine financial resilience, building the capacity to truly provide for yourself and those around you, and hopefully living life debt-free.